In this video clip, I'm going to look at the calculation of the adjustment for depreciation when we reverse an intergroup transaction by using the information in question 17.7. When an asset is sold between two companies within a group, one of the companies would have recorded a gain or loss on the sale of the asset in their accounting records. However, from a group perspective, that asset or that gain or loss on the asset has not realized and need to be reversed, because our aim, of course, with a consolidated set of financial statements is to report only with on the transactions with external parties. So any internal transactions need to be reversed. Okay, so if we still have that asset, that unrealized gain or loss that is recorded in the value of that asset needs to be reversed. The second adjustment that we have to do relates to the depreciation. Because the company that bought the asset and now owns it, they would have based their depreciation calculation on what they paid for the asset. But for the group, the depreciation needs to be based on the original cost of the asset when that asset entered the group structure for the first time. And as we make the adjustment to the depreciation, that represents the use of the asset, and as we use that asset, we have to reverse the deferred tax that we originally raised when we adjusted for the unrealized gain or loss on the sale. Okay, so it's three sets of adjustments that we need to do when we reverse the gain or loss on an asset sold between companies within the group. Now, in most questions, you would have been given the selling price or the transfer price when the asset was sold to the other company within the group, as well as information on the cost or the carrying amount of the asset on the day that the asset was sold. This is, of course, now with regards to the inter-entity or the intergroup transaction. In this specific question, we weren't given that value, so we don't know what the carrying amount was on the date that the asset was sold, and we don't know what the value of the selling price of the asset was that the company paid for it. So in this question, Meyer Limited sold an item of plant to Brooke at a profit before tax of $4,000. Okay, so we don't know what Meyer originally paid for the plant, and we don't know what Brooke paid. But however, we do know that Meyer recorded an unrealized profit of $4,000 before tax on this transaction. So irrespective of the values, the carrying amount and the selling price, we know that Brooke would have recorded this asset at $4,000 more than what the original cost was, or the carrying amount on the day of that the asset was transferred into group. So that is the figure that we need to reverse against the carrying amount of the asset or the cost of the asset. So that is the first part. We will reverse that by debiting the gain on the sale of the asset, crediting the asset. So we reduce the value of the asset. Because of that adjustment to our carrying amount of the asset, we record a deferred tax asset. And the second adjustment then, if you recall from the previous slide, is then to deal with the depreciation. Now, the reason why we need to make an adjustment on the depreciation is that Brooke will base their depreciation calculation on what they paid for it. So that selling price, the amount that they paid for the asset, that's what they're going to base their depreciation calc on. However, from a group perspective, that is not the value that we should base our depreciation on. We should base it on what that asset was worth on the date of the transfer in the selling company's accounting records. Now, once again, we don't have those values, but we know that the difference between that is the 4,000, the unrealized profit. So it means, therefore, that the depreciation adjustment would be the depreciation policy based on that 4,000 unrealized profit. That is the amount of that we have to base our depreciation correction on. Okay, so they depreciated at 10% per year, and we use the depreciation rate of the company that currently owns the asset, so Brook Limited, 10% on cost. So we can therefore draw the conclusion that our depreciation in the accounting records of Brook would be depreciation on the $4,000 more than what it is from a group perspective. So we have to reduce our depreciation expense by $400. Okay, and of course the tax effect on that. Now, to complicate this just a little bit more, this intergroup transaction happened in the previous financial period. So we've got a 1-year adjustment, and then we've got the current year when we do our consolidation worksheet. So we first of all have to make this adjustment that brings in the effect of the first year after the asset was sold against our retained earnings opening balance, and then we also have to deal with the current year. So this is done by analyzing the original adjusting entries. So that affects our income statement, and that affects our income statement. So in the current year, these two entries will be adjusted against our opening retained earnings, and this is to ensure that our opening retained earnings ties into what was reported in the previous financial year, and the adjustment to bring our asset value in line to what it should be from a group perspective, and the deferred tax provision on that adjustment to the carrying amount of the asset. So that is the first part, and that is to reverse that unrealized profit that sits in the value of the asset. The second is then to deal with the depreciation. So once again, we look at in the previous year, we've got an adjustment against our retained earnings opening balance. So that is for year 1. And then our depreciation for the current year, year 2. So that is, yes, for the current year. And both these entries are adjusted against our contra account of the asset, the accumulated depreciation. The third adjustment is then just where we deal with the tax consequences of the depreciation adjustment. So once again, we look at the previous year. We had an income tax expense adjustment, which affects our earnings for the year. So for the current year, that would be adjusted against our opening retained earnings. So that's the year 1 tax effect of the depreciation adjustment, and then against our income tax expense is the year 2 adjustment. So those two tie in, and our credit entry is against the deferred tax asset, so the reversal of the deferred tax asset as we use this asset as represented in the depreciation adjustment that we do.